Hello, everyone, and welcome to our PropTech panel. When America sneezes, Australia catches a cold. The impact of the US economy on Australian PropTech. Thank you for joining us today. My name is AJ Chand, and I'm a founder and CEO in the PropTech space, also a board member of the PropTech Association of Australia. Before I begin, I'd like to acknowledge the traditional owners of our land and pay respects to elders past, present, and emerging. A special thanks to Stone and Chalk and the PropTech Association for making this event possible, and a great big welcome to our guests, Ginsburg from Earnnest, Marisa Warren from ALIAVIA, and Peter Schravemade from Reach. The tech space is ever-changing, more true than ever since the start of this year. We have seen huge tech layoffs, company valuations slashed, capital constraints, leaving founders, CEOs, and investors, with everyone asking what's next. We have seen many tech platforms scale into the US, and we've seen US tech platforms scaling down under. How will this change affect our startup ecosystem? I believe there is no right answer, but our intention today for this panel is to shed some light to this. Let's begin with you, Ari. Ari, you recently moved to Australia from the US. Tell us a little bit about your background in PropTech and how you feel the Australian and US markets compare.
Hey, sure. Great to see you, AJ. Thanks so much for having me here today. I was in the traditional insurance sector for about 20 years. Wanted to change and follow one of my passions, which is real estate. Beginning in the mid-20-teens, I worked for several fintech and PropTech companies, initially as a subject matter expert. I was fortunate to work in several real estate subsectors, including payments, valuations, and home investing. Had an opportunity to move to Sydney mid last year, and it's been fantastic. Met some of you through the PropTech Australia Association, and hope to meet more of you. With respect to the second part of your question, how do the Australian and US real estate markets compare? So there's a lot to unpack here. And I'll probably break this down into three separate parts: differences, similarities, and also the commercial side. There are obviously a couple of big differences. One is the scale of the market. Population, number of units for sale and for rent. And the other is the distribution of financing risk. And by that, I mean, who owns borrower credit risk and who owns interest rate risk. In Australia, banks take on credit risk and pass on interest rates to borrowers. But in the US, it's really different. And in large part, government agencies take on the credit risk, and investors take on the interest rate risk. So it pretty much leaves the banks in a lot of cases without substantial risk to residential mortgages and existing borrowers without facing the risk of rising rates. By comparison, this year in Australia, I think the RBA estimates that approximately 800,000 homeowners are facing risks of significantly higher interest costs, because they'll just roll to a higher rate. Borrowers are going to be hugely price sensitive now that their mortgages are going up. And if they can get a discount on expenses or on costs or on rates, it's going to be real money. I think a year ago, borrowers were just not as price sensitive, because rates were so low. It just didn't matter. So now I think they're going to shop, they're going to compare, they're going to seek quick execution. So I think this is a huge opportunity for PropTechs to provide value. They can use technology to take friction to sort of out of that system, but by helping consumers and borrowers execute quickly, efficiently, and more effectively. I think there are also some similarities as well. And top of mind for many people in both the US and Australia are the challenges of home availability, affordability, and house price appreciation. Availability drives affordability, and affordability is driven by home price appreciation and now rising interest rates. Here in the US, there are several factors which I think contribute to this. One is the availability of skilled labor, or who's going to actually build your house. The second is zoning, which may be more of a political issue in nature, but it really goes to home density, house density. And the third is the effect of climate change. Home ownership in the US and Australia, actually globally, is usually the largest individual asset and single source of wealth. And it's often at risk for damage or destruction related to increasing incidents of climate events. Many of these risks are either underinsured or likely to be uninsurable in the future given the current construct. So, you think about the recent floods in Auckland, the floods and fires that we've experienced here in Australia, as well as California for that matter, and the severe hurricanes on the East Coast of the United States. So I think that the people who can figure out, how we build more sustainable homes, that are green and can survive more of these events without being destroyed, that's a global thing. And sort of understanding the intersection, between where we can remediate the current housing stock and make it more sustainable and insurable, it's going to matter to everybody. It's going to matter to governments. It's going to matter to homeowners in particular, but it's also going to matter to lenders because the house is the largest part of collateral behind their loan. And on the commercial side, in both the US and Australia, in a post-COVID world, if in some instances people are only going to the office, say, for example, 2 to 3 days a week, there has to be a better way to manage commercial occupancy. I think this is an opportunity for a fundamental shift where, in certain instances where, less commercial space is needed, and to determine how it's used. If it's just not efficient, if there's 100% occupancy on a Tuesday or a Wednesday, and then a fraction of that on Mondays, Thursdays, and Fridays. So again, I think there may be an opportunity here to yield manage space, in some markets, not all markets, but in some markets. And a good example of this, I think, is if you think about the airlines, think about Qantas. During COVID, Qantas yield managed flights between Sydney and Melbourne. If you can figure out a better way to optimize the current space, I think you're going to get paid a lot for it. Can't hear you.
You've raised some really good points there, so thank you for that. So what are the key economy issues impacting the US, and how are they affecting US real estate and PropTech?
So I think the short answer is interest rates, inflation, and housing supply, which I sort of touched on. But for purposes of this conversation, I'd rather talk about what I think are maybe some more interesting drivers, which are the US debt ceiling, demographic trends, and drivers around choice. The debt ceiling in the US in the short term can create significant volatility in the global financial markets if the US just can't sort out and increase the debt limit. Currently the US has reached its borrowing capacity, and I think that's somewhere around 31 or 32 trillion dollars, which sort of sounds sort of amazing. And the Treasury right now, the US Treasury, is using extraordinary measures to ensure that it doesn't default on its own debt. These options, though, can run out as soon as June. So if that happens, it's big, and Australia wouldn't be immune, actually. While I am concerned about the ability of the two political parties in the US, the Democrats and the Republicans, to sort their way through it, I pretty much have every expectation that if they do mess this up, that they will rectify it really quickly. Going to this sort of the second point with regard to demographic trends, I think demographic trends are critical, when it comes to the US real estate and PropTech sector. And by that, I mean household formation, because household formation is changing. And I don't think that's just a US phenomenon. More and more people are single. There are more couples who are not having children, and there are aging baby boomers. And I think this requires thinking about changes in what people seek in housing, in their housing stock, and how it better fits their needs. So again, I think there's a number of prop tech opportunities here. And the last one is sort of drivers around choice, and this dovetails to maybe something I said a little bit earlier. But in the past, people lived near where they worked, and now they may have more choice. Again, this could be preference, whether or not you like the beach or if you like the mountains, and it also could be climate driven as well. But I think we're seeing changes in home prices in some places where we just didn't expect this because of the flexibility of where you work. So, I don't have a crystal ball, so I can't tell you, so it's not clear if this is a forever trend or if this is just something that we're just seeing right now.
And how is this similar or different to what we're seeing here, do you think?
So I see a couple of differences and a couple of similarities. Thankfully there's no debt limit crisis here, but there is a very different impact of debt service cost on individuals seeking individuals' existing mortgages, or people who are rolling off of fixed or even variable rate mortgages. So I think in the US, rising interest rates have very little impact on existing borrowers, but here in Australia, that impact could be pretty significant. The second part, I think, is with respect to valuations. As home values are expected to decline in Australia at a more accelerating rate in the next 12 to 18 months, I think lenders and homeowners are going to want a frictionless, fast, and accurate home valuation. As both mortgages are reset, and there are new buyers who come into the market as well. Lenders are going to require it, homeowners are going to want it, and again, I think of it as another prop tech opportunity for valuation companies to demonstrate their technology strengths. So I think there'll be a lot of people who will pay for it and will pay more for it. By comparison, in the US, rising rates have disrupted the investor market. Tech capabilities evaluation are going to be much more valuable now to investors because the market in the past in the US, anybody could basically buy at incredibly low rates and then rent out the property and make a good return. And I think that's changing. And think about the economics on a portfolio of 10,000 units. So I think that the last part with respect to drivers around choice, let's just take a look at price appreciation during COVID in areas outside of Melbourne and Sydney. Take Brisbane and Adelaide. People moved because they could work remotely. They purchased homes or second homes in areas of preference, and prices increased much more than we originally anticipated.
Yeah, so true. I think the movement of people, because now everyone can work from home, the choices are just much greater than they used to be. So it is definitely moving some of the real estate trends. Again, after COVID, it's everything, all the trends are changing. So it's interesting. So what's the vibe in the US at the moment? Is it more positive or negative to what you're seeing here?
It's a bit of a loaded question. I think in the real estate sector, the vibe is more negative in the US than it is in Australia, to be honest. Many markets, I think it's very frustrating, because there's just limited residential housing stock supply. There are incredibly low fixed rate mortgages in the past have essentially locked a lot of people into their homes. And otherwise, if they were to move, it would be far more expensive. On the commercial side, it's a bit of a bifurcated market. There are significant vacancies in New York, in San Francisco, in Chicago, and in Boston. But if you go to Charlotte and Tampa, there's a commercial real estate shortage. So I think if you look at it from a prop tech perspective, in the US, prop techs of all sizes and fundraising rounds are just they're just having more difficulty raising capital at valuations they think are fair. And I think, in part because investor expectations have changed. In the past, there was an expectation that a startup could burn cash for 3 to 5 years. And I think now investors have a much shorter horizon on cash burn. So they're just looking for a much more managed approach. Also, I think with very low unemployment, we talk about layoffs, but now let's go to sort of the broader metric. I think PropTechs have two choices. They either can pay more for talent, or they can try to forego a cap raise and dramatically reduce expenses. We're seeing both in the U.S., but I think right now it seems like there are more PropTechs in the U.S. that are sort of in this expense reduction mode.
Yeah, and that is true for a lot of Australian PropTechs as well. From what we're seeing in the market, it's reducing burn and making sure that you can survive the next 18 months or to do a capital raise. And there's definitely alternatives now, and a lot of founders are doing the right thing, I think, in that aspect. What about the broader tech industry? There's been a lot of layoffs in the big tech companies. Is that affecting the global industry, you think?
Well, I mean, tech layoffs they've been on the news a lot, and it's what's made the vibe pretty negative in the U.S., particularly over the past 3 to 6 months. Tech companies, particularly what I'm going to say are the large household names, scaled up dramatically during COVID for future growth, and now a few different things have happened. The economy is pumping the brakes a bit, so larger tech companies, they want to manage their expense base because they're expecting and they're starting to see revenues decline a bit. And I also think there's something else that's happening. It's a little bit of an interesting phenomenon. Tech companies are looking to the left and to the right a little bit, and they're starting to see layoffs in either in their sector or in tangential sectors. And so I think there's a little bit of the contagion effect here as well. People are starting to think, how can we do things a little bit better, smarter, differently with fewer people? In the U.S., PropTechs unfortunately led the stream of layoffs, but it's not just PropTechs and tech companies that have been affected by the layoffs. In the U.S., the entire real estate sector, has reduced staff a bunch, and there are just fewer homes on the market. There are fewer deals. There are fewer home purchases, much fewer refis. So I think there are just fewer revenue generating opportunities. And it's not surprising given interest rates. It's happened before, but I think what's surprising is how quickly it's happened. Yeah,
that is, I think, 9 interest rate rises, from the RBA in Australia. Like, I don't think anyone expected that, but it is what it is, I guess, at this stage, and it looks like it's going to worsen before it gets any better. Mm-hmm. What do you think are the key differences between Australian and US PropTech?
So probably the other panelists are maybe better to answer that than me, but I'll take a shot. I'm looking at here. I'm still pretty fresh in Australia, so it may be premature for me to comment in depth here. But I can take a stab and talk about a couple of things. I think first, the U.S. is leading the world with a number of PropTech companies, of all different sizes, of all different sort of capital funding, and the overall sector is a little bit more mature than Australia. It doesn't mean better, it just means more mature. And I think sometimes the smaller nascent US PropTechs just have more difficulty getting a seat at the table. So I think it may be easier for smaller Australian companies to get the attention of capital providers, investors and partners. And second, and this is, from some of the conversations I've had with folks here, I'm going to sort of put this under the heading of international or global focus. And I've noticed that Australian PropTechs initially think about transferability to other markets outside of the United States, outside of Australia. And in part, it may be out of necessity, because of the size of the addressable market here. And I think it's the way, PropTechs here, they structure companies, the way they code, the way they develop, and the way they envision their products and their use cases. And I think by comparison, PropTech companies in the United States, they often focus on a proof of concept and envisioning themselves as a US-based company and focus on the build without fully considering an international component. And again, it may be because the addressable market in the US is much larger, but I think that's a mistake. And sometimes I think it'd be pretty costly in terms of having to either redevelop or or modify licensing or from certain regulatory issues they may face as well.
Okay, so what does the next 6 to 12 months hold, you think? I know it's a broad question, but just your thoughts on it.
So in the U.S., assuming Congress increases the debt limit, I think we're in store for at least a couple more rate increases from the Federal Reserve. I think the economy, despite the layoffs in fintech and in PropTech and in real estate, is still incredibly hot, and unemployment is at historic lows. I think the U.S. unemployment rate right now is at a 50-year low at 3.4%. Keeping inflation down is top of mind for politically as well as economically, and nationally, I think home prices will probably remain sticky with a little bit of downside. I think inventory is going to stay exceptionally low, but I think what you're going to start seeing is inventory sitting maybe a little bit longer, and overall, I think there'll be continued pressure in real estate, PropTech, and by extension in the fintech sector.
Thank you, Larry. That's very insightful. I appreciate your comments. Yeah. Now to you, Marisa. Can you please tell us a little about yourself and ALIAVIA Ventures, please?
Absolutely. Yep. Dialing in from Brisbane today. So I've been on a bit of an Australia-wide tour and usually live in Laguna Beach in California. So my background, so two sides. So there's the tech side and the property side. So on the tech side, I got into tech in '97. So I've seen a few up and down cycles. Worked for companies like SAP, Microsoft, Workday, both across Australia and the US. I'm one of those lucky ones that have dual citizenship. Lived and worked in New York for a number of years and now obviously in California. In 2015, I said I've been a bit disillusioned with tech and the lack of females in tech. Started a pre-accelerator for women tech founders to help them get investment ready and funded. That was called ALIAVIA. Since then, we've had 175 women through the program, both across Australia and the US, that have raised more than 120 million and had 3 exits. That was sort of key to then the next part of my journey, establishing a venture fund. So in 2020, in the midst of lockdown and realizing we were having weekly calls with our alumni, both across Australia and the US, and we just saw funding dry up overnight for women. So both the accelerator and the VC fund, when we say women founders, we say there must be at least one female founder on the founding team with a significant equity position and C-level roles. So we have plenty of businesses that are solo female, joint, male, female, husband and wife as well, and then 2 female founders. So that then that driving force, we saw we had all of these fantastic businesses coming through the pre-accelerator that were struggling to raise funding. Started the venture fund, launched that in 2021. And today have now 8 active investments across the US and Australia. We invest in enterprise and consumer tech, and then there is a PropTech business as well that we've invested in out of Neighbourlytics, out of Melbourne. And it's that pre-series A as well. So we've got in as early as pre-seed, so pre-product and pre-revenue, all the way through to seed plus rounds now. So we do, if you're not quite at the Series A level, but you're further than the seed, seed plus.
And how do you determine that? Do you determine that with product market fit, initial stages of revenue? What can you tell us a little bit more about what attracted you to, say, Neighborlytics, the female-led?
Yeah, absolutely. So the first point is really the main metric there is revenue.
Yeah.
So you and now really at Series A, VCs are expecting 2 to 3 million annual run rate US as well. So if you're not at that point when it's coming to do a Series A raise, and we're typically saying do seed plus. So the interesting thing about Neighborlytics, so over the last few years, is obviously we've seen, and Ari touched on this, we've just seen this, and we all have all lived it, just this massive shift in where we live and work, impacted by COVID. And what we really like about the Neighborlytics when we were reviewing to invest is that they're providing this data, insights, and intelligence, both from and taking in social data to understand why people are using the different spots in a neighborhood, but also what they are actually using, the assets in that neighborhood, how long they're spending there, what time they're going there, but the social sentiment, like that they're capturing, oh, this is a great place, and sharing, but then also comparing neighborhoods that are doing very well with neighborhoods that are not doing so well, and looking at the sort of insights between the two, and how then it's really property developers and sort of your equivalent of sort of local council can then improve those neighborhoods to attract more people, and at different times of the day. And then also determine sort of the asset mix in those different neighborhoods. So that's what we really, because it's, as Ari touched on, like it's a really interesting property market in the US at the moment. You have this whole, very much there's a lot of the work from home. My husband's actually a partner at Deloitte. He's been there for almost 3 years now. He's only been into the office 3 times. So he works from home. He travels to customer sites but you have a lot of that. And it's, you have a lot of these corporates that are saying, well, we'll have a flexible policy. So if you want to work from home, you can. And so then that's driving different behaviors. There's also a lot of commercial availability in areas like San Francisco. All of these office spaces, they're just not being used. And so it's going to be interesting to see what the industry actually does with that. New York, after you had 9/11, they converted a lot of the buildings down in sort of in the financial district to residential. And so that worked really well. It'll be interesting to see in areas like San Francisco what they do with those commercial buildings that just are not being fully utilized. Then you have on the residential side. So we bought in Laguna Beach. What was it? End of 21. And literally, that's a market that has very limited supply. And the prices just kept going up, and it's very competitive. You don't have an auction market there, but it's private sale. We bid on a house. We were successful in the end, but things like we had to, produce a little video of us to the owner at that time, family video, saying what we loved about the property and how much we want it. And we just, offered a little bit over asking and were successful in it. But we had to do, you had to do creative things like that from a buyer perspective to get the properties. Because it's also, that sort of blind, even though it's private sale, sort of blind auction type process. Watching the market now, I would actually, in that market, there's actually more supply, but you have, with all the interest rates hikes, it's cooled down the market, and you have properties that are sitting on 30, 40, 50, 60 days, like a lot longer versus the 2 weeks they averaged before. And you have constant price drops. So you have sellers that are still not sort of in tune with the market and what people want to pay, and they're having to drop prices. So it's really interesting. And then like every market is, New York's was crazy before, like during everyone left New York, rents dropped significantly. You could pick up really good deals. Now rents have actually gone up higher than what they were before COVID, because people have come back. So every market's been behaving very, very differently.
And that is actually very similar to what happened in Australia, right? Like 2021, we didn't have to make videos, let's face it, but it was the market after COVID was just increasing at a rapid rate, like 20-30% gains. And it was so competitive to try to get into the market. And that could have been because of the interest rates. But it was also, you would never think that coming out of a pandemic where there was so much disruption to business, to economy, that you would have property prices scaling the way they were. I just found it very amusing that you had to create a video to win a property. That's never heard of that before, but that is incredible. To the vendor itself, it was to the owner, it wasn't to the agent, right?
Exactly.
Jeez. Okay. So what do you think are the key differences between Australian and US PropTechs when it comes to, say, funding?
From a funding perspective, well, if I can just make some comments because it links in with that around the overall sort of health of sort of the economies. So it's interesting. We see really in the US, yes, they've raised rates, and as I said, it's had an impact, really only cooling the housing market. The underlying fundamentals within the US economy are just so strong. Record unemployment. We're not allowing as many people into the country. So we have labor shortages across literally every industry. Even though you're having all of those big tech layoffs, it's actually interesting when you look at the data. The staffing levels of these big tech companies are going back to around sort of early 2022. So it's not, you had this insane hiring in 2021, and last year it started to ease off, but it's not, it hasn't gone significantly backwards. So it is still fundamentally a really strong economy. Many of our investors and us, we don't actually see the US going into a recession. We don't see that it's possible. The challenging part is what's going to happen with the inflation, because that's out of control still. And even if you keep raising rates, is that actually going to have an impact because of all of the other positive business model fundamentals? In Australia, we see it serve as a fairly similar story. From an investment perspective, there is so much dry powder in both the US and Australia. You have venture funds still raising, record money from LPs, and they're sitting on that. They will become a point where they have to deploy it. The US market is acting a lot more like the Australian market, investment market now. Before the last 10 years, it used to be growth at all costs. It didn't matter, if you weren't making any money. We just want to get, how quickly can you get to, 1 million users, and then we'll work out to the monetization strategy and business model after that. That's no longer the case. Now there's this focus on, okay, if you're a first-time founder, You have to have revenue coming through the door that's in a repeatable sales model, and lean on costs. Investors aren't liking the look of companies that have a really high monthly burn, and particularly on marketing and advertising. So that's very much out of favor. So yeah, it is the most conservative investment market that I've seen in the US since probably the dot-com days, dot-com crash days. Then in PropTech again is you have a few players. You only have a handful of players that are focused on PropTech itself. You have some of the generalist funds that will dabble here and there, but there certainly isn't as many that are purely focused on PropTech.
Definitely. So what's the vibe in the US at the moment? Has the funding for tech startups slowed or accelerated, do you think? I know you mentioned that a lot of VCs do have a lot of dry powder and there is a lot of funding to be deployed, but do you think in general, has it slowed or accelerated?
So it's interesting, before this so we started preparing our companies back in March of last year. We said, downturn's coming. We don't know if we're going to go into recession. We don't know how deep and long it's going to be, but let's shore up our balance sheets, extend as much runway. We sort of modeled out with some of them which ones had to do bridge rounds versus from existing investors versus going out to market for new deals. So that's sort of positioned them really well. What you have now here in the US, where it used to, before sort of February, March of last year, it was an extremely competitive market. Hot deals would be done in, like, for investing would be done in 2 to 3 weeks, from the time that the founders open up the round to closing out the round. You'd have investors that they would have one conversation with a founding team, and then after that present a term sheet. That then presented a lot of problems as well, where you've had some of these big high-profile tech businesses hitting the wall because the lack of DD that the investors actually did. So now, whereas it would have been sort of 2, 3, 4 weeks sort of really rapid funding rounds, it's now a number of months because they're wanting to go deeper on the DD. Again, US investors are acting more like Australian investors, saying we need to take our time, we need to get to know the founding team and management team a bit better, and really drill into the business.
That is very similar to the feedback we're getting out of the VCs out of Australia as well. Like, typically before, they used to spend 2 or 3 weeks before term sheet, but now they're spending around 3 or 4 months with the founders to get to know the business, to get to know the problem they're solving, which I don't think is actually a bad thing. I think it has a lot more buy-in from the funding industry as a whole. What does the next 6 to 12 months hold in the VC space, do you think?
Well, I'm actually incredibly optimistic about this year. And I think, there's a couple of, we do actually have 4 of our portfolio companies that are looking to expand to the US this year. And part of that, once you an Aussie business expand to the US, you have and get good traction, it results in still quite a significant valuation uplift. Because you just the pricing, you've still got the US is still valuing deals a lot higher than Australia, and technologies like ChatGPT and GPT-3 coming out. We've a lot of our companies are using that either within their internal organizations or within the product development side, and I think that's an incredible platform that is going to be transformative for our industry. So like when these, mobile devices sort of came out, it's that type of transformative. But overall, I'm actually quite bullish this year.
Yeah, that's great. That's good to hear. And yeah, like when we went on a break, for example, in December, and we came back in January or February, ChatGPT was out there, right? Like it's, I think the cost of resourcing now is so much lower because of ChatGPT. You can write code, although it be a draft, you can write content, you can do a lot of things. That actually does reduce the time for the startup and the resourcing needs for the startup, which is, I think, great for the industry and great for tech in general. I think it's going to really take off.
Yeah. There's a strong likelihood that you'll see in the next 5 years, you won't actually need to code anything. It's more just reviewing code versus actually doing it from the ground up. It's so to be, very.
I think it'll be great. Any advice for Aussie PropTechs thinking of scaling into the US market?
You still do. So revenue, I like to say revenue is queen. You gotta have consistent, repeatable sales revenue. You need to get on the ground there. Every market is so fundamentally different. Even, in California, I lived in LA for a bit. It's very different to Laguna Beach. Different to New York, different to Texas, different to every market is very different. The one thing is understanding where your customers are, and basing yourself there for by far founder-led sales to start off to launching into the US is the best way to go about it. And to really sort of understanding your market and how your customers buy.
Thank you, Marisa. I appreciate your time, and that was some very valuable insight into how we can scale into the US. And finally, to you, Peter.
Saved the best for last, didn't you, AJ?
They did save the best for last. I'd like to also welcome you to the board of the PropTech Association. So Peter is one of our newest members. Peter, can you please tell us a little bit about yourself and the REACH program, please?
Yeah, well, I've without going all the way back, I've been in real estate since 1999, which makes me quite old. Really, that's all it does. Aside from running, actually operating in the real estate space, I was part of Box Brownie, the PropTech startup, I guess you would call it here. It was here on the Sunshine Coast, now a global operation. And now I'm with REACH Australia, and REACH is primarily a venture capital company, but it is it's the venture capital and accelerator arm of Second Century Ventures, which is attached to the National Association of Realtors over in the US. So I'm effectively the Asia Pacific division of that arm.
Yeah, excellent. So I've heard a lot of things about REACH and Second Century Ventures. Obviously, a lot of startups, in Australia, that's probably one of the first sources that you go to either get funding or to get some validation. So, it's played a massive part in the Australian PropTech space from the start. So since REACH is a global incubator in the real estate space, what are some of the key trends you have noticed in the international markets when it comes to PropTechs?
Well, I'm going to echo what my learned friends have already said. I feel as though one of the trends at the moment is if you're not commercially viable as a PropTech, you're going to be experiencing some pain. The funding has all but dried up. I was in the US at the start of last year in New York, and somebody was telling me about some crazy idea that they had valued at $38 million. And I didn't think the idea was even a good one. But this was the valuation they had on the money that had been thrown at these people. And I just thought, how far removed this was from the Box Brownie days when we we rolled into people's places and said, could you give us funding? And they were like, no, get stuffed. And we'd leave with our tail between our legs and off we'd go. So, you know, I feel like all we've done is we've returned to the some semblance of normalcy. And I'm actually welcoming it. I know there are a lot of PropTech companies that are going through a bit of pain. And yes, I've seen the layoffs over in the US. A lot of them are my friends from the vendor industry that I knew over there. So I'm feeling it particularly deeply at the moment. But I do believe it is there's a bit of a vacuum when we've gone through a period of time where it's pretty easy to come by capital. And now a lot of the investment companies have their hands in their pockets despite having the money there. So, you know, we've already heard that both from Ari and Marisa. I'm seeing that a lot. Another big factor that I know Reach is looking to, and Second Century Ventures is big on, is we're looking for dual industry tech companies. So we are obviously unashamedly PropTech. We have members who are realtors or agents, as we call them over here. And those members mean that we are focused on PropTech. But one of the more exciting areas that we like to see is when that PropTech has a bit of a twist, where it might be involved in finance, or it might be involved in construction or building tech, but also impacts on the PropTech market. A lot of the research that we've done suggests that those tech companies perform well over longer periods of time, because when one industry dries up, there is another that they can rely on to go there. And indeed, Box Brownie, I'm not sure if you're aware of this, but it is a dual industry, multiple industry tech company where you've got the PropTech, but it's actually a marketing tech company. So they were heavily tied to MarTech and PropTech, and that's a trend that we're seeing VCs look at particularly favorably. But commercial viability, it'd have to be the biggest one at the moment.
Yeah, I think multiple verticals is always better than the one, right? So I've seen a lot of crossover between PropTech and FinTech in the recent times, you know, like processing payments or taking payments, and also being part of PropTech and being part of FinTech, which for the companies that can pull that off, I think that's a better story to tell in general, I think. So what do you think are the key differences between Australian and US PropTech?
Well, I'm going to argue with Ari here. I'm going to agree to disagree with him. I believe the Australian property industry is more mature than the American. We can have fights about this later. Maybe not from a financial standpoint, but we've got a regulated industry here, heavily regulated by government. So if I do something bad as a property consultant here, I go to jail. As opposed to getting a $200 fine from an MLS or an association. So, you know, there's a big difference if I stuff around in someone's trust account. And then on top of that, the market operates incredibly differently everywhere outside of North America. North America's kind of got its little insular shell, big market. But and we also punch way above our weight. Like our property industry is 10 trillion and the US is 40. Now, if you do the numbers just on population, we shouldn't have $10 trillion worth of a property community here. So the addressable market is actually way bigger than where it should be, and that's the value of the Australian property technology community. Probably the other thing that I would say, that I see Ari laughing, we'll give him a chance to say something at the end. But the other thing I would point to has been a massive issue for Australia versus US. I've met US PropTechs that survive just in Casper, Wyoming. And for those of you who don't know where that is, that's in the middle of nowhere. But I've met PropTech companies that can do that because of the sheer scale of the market. But if you show me a PropTech company that can just survive in Newcastle or Coffs Harbour here in Australia, you know, I haven't seen it. The size of the market allows for more players to be in the American market, but that doesn't necessarily mean they're more mature. It just means anyone with an idea that actually works in one particular area can actually make a successful career out of it. So I have felt that when Australian PropTechs go across to the US, a lot of the smarter investors actually, their ears prick up and they are treated as being more mature, because by the time you're on a plane and you're over in the US, you've done something right to be there, to even earn that spot. The cost of just being over there alone is quite difficult. And then we've got, the Australia versus the US dollar to compete with, and all of the challenges that come with that. So, I feel when I look at an Australian property technology startup, they've survived in a particularly harsher environment. And if they've done well in that, then quite often going to the US, if the idea actually fits into a different market, they can do quite well over there.
So on touching on that too, so you might have some case studies on some of your portfolio companies scaling global within the REACH program, because REACH is a global organization.
Yeah.
Any of them come to mind?
Yeah, well, I mean, box brownies probably central. That approach I don't think had been done before. There's two different approaches that I can identify with companies scaling to the US. There's a top-down approach, and what I mean by that is that if you look at Rate My Agent or Open at the moment, they are on a top-down approach, where they've gone over to the US. They're seeking franchises, MLSs, associations, large brokerages or super agents, or even the coaches associated with that. And they will try and get a decision made at the top that affects all of the agents that sort of sit underneath that pile. And the other way is the bottom-up approach, or grassroots, as I would call it. It's a heavy boots on the ground presence. And that would be the box brownie approach. Market Buy is another company that are looking to do that at the moment. But that grassroots approach is way more difficult. It cuts out the top-down approach, and it means that you're after the hearts and minds of the agents over there, which is very, very difficult. It's a difficult gig to pull off, but if you can pull it off, it embeds you in agents, regardless, agencies, franchises, MLSs, associations. They have to look at you because it's a popular vote rather than a I'm here to brown nose to the owner of whatever the franchise. I'm putting a generalization out there, but they're the two different types of approach that I can see have been employed by rich companies. And we've got Box Brownie, Rate My Agent, Open, ActivePipe. Well, ActivePipe just acquired Market Buy, Future Rent, Ubi Park, PAM. They're all making plays at the US, and there are more. I think this year alone, I've done nearly 6 strategies for REACH companies who are looking to go to the US in particular.
That's interesting. I think there is a lot that's going down, and like you said, the top down or the bottom, there's no right answer to that, is there? Because you could spend so much time at the top trying to filter it down, but then not pay attention to the bottom, which could potentially be a problem with the market fit for the US as well, because you haven't got any of the potentially the low end of the consumers or the businesses trying your tech out too.
Yeah, and I feel like that speaks to understanding the North American market from an Australian perspective. If you just go over there and go, we're going to do things the same way we've done them in Australia, you're a bit of a moron. It just doesn't work like that way. And you actually have to go over there, ask a friend. Our first forays from Box Brownie into the US were just fraught with mistakes. I mean, Ari and Marisa might get this, but our first advert to the US for Box Brownie was, would you like warm, homely furniture in your listing? Because we were advertising virtual staging. Now, homely in the US means crap furniture. But I didn't know that. I didn't, I'm getting all these people post underneath it go, what an idiot, fire your marketing manager. Well, that was me. So, I'm running around trying to sort out what the problem was. But we've actually got a store over here, AJ, called Homely. It sells furniture. We've got a portal called Homely. The Americans just wouldn't go to that because that's like squatters' furniture. Well, I didn't know this. I had no idea. And so, what that speaks to, what that lesson should speak to, is if you're a PropTech company and you're listening to this, you've got to go over there and have a look at it. You've got to actually sound out and test the market. I really like what the guys from Market Buy have been doing. They've gone over to multiple events and multiple different trade shows or conferences, and they've sort of how does this work with you? And then they've got beta testing with large, medium, small brokerages to go, does this actually fit with you? And they found they had to remodel their complete product in order to do that. So very smart approach by those guys. But yeah, it's not something that you just decide one day, I'm going to flip this switch and we're going to go to the US and we're going to make money. I know you get stars in your eyes when you look at the size of the market and the amount of real estate agents over there, but you've really got to be a bit smarter about how you approach it.
So what does the next 6 to 12 months hold in the PropTech space in your opinion?
I'm with Marisa. Opportunity. Whenever everyone's talking doom and gloom, I get excited because there's an opportunity that exists out there, even in markets where it's slightly depressed. And yeah, they're depressed over in the US at the moment. You just have to pick up a phone to any of my friends over in the PropTech industry and they're fearful of their jobs. I've got people reaching out to me asking me, I may not have this job next week, so do you have one that you could suggest for me? And I can't remember the last time that happened. Probably when Realtor.com laid off a ton of workers, I had that happen then, but that was isolated. So yeah, I think in the PropTech space over there, it's particularly doom and gloom. Over here, we've seen more mergers and acquisitions, and I do believe that comes back to what we said before about PropTech's their solvency, their ability to stand on their own 2 feet, and the cash running out from VCs, because you'll see a lot of those M&As happen when they're unable to fund themselves. And I think we're seeing a lot of that at the moment in response to we're not going to get the funding. So now might be a time to cut our losses and let's either sell or let's merge to continue on. But 6 to 12 months, if I had to list the opportunity, I feel as though for Australians looking to go over to the US, I think this is great timing to get your name out in the industry. There's less noise in the PropTech space. A lot of the companies have sort of filtered out. So on the vendor hall of Inman Connect in Las Vegas last year, 33% of the companies were from this region. And that used to be Germany. Germany used to have, you used to go to Inman and Germany would have all of the PropTech companies, and there's no Germans there now. It's Australia, New Zealand. I see a bloke who writes for Venderelli. His name's Greg Robertson, former Reach mentor. He said that Australia's been viewed as the new Canada of PropTech startups. So he and that's a compliment, just in case you're wondering. It means we're the poor man's pool of where to go to. And on that, I do agree that there's Marisa made a comment earlier about they've got the powder there to buy. Australian PropTech companies are viewed as being way more affordable than the US companies, just because of the dollar alone. So there are a lot of VCs over there who would be eyeing off, purchases that are easy for them or simple, if you can demonstrate as to how you fit into the market.
Oh, thank you for that, Peter. So we do have about 3 minutes left. So if there's any questions, please feel free to pop them into the chat and we'll be happy to answer them. I think, overall, from what I hear from Marisa and yourself, Peter, is that, there's plenty of opportunity. You're actively investing in companies, and Australian and New Zealand PropTechs are actually doing quite well overseas. So this is all very reassuring to our startup community, and I think we are seeing similar things. And I guess markets will always change, and trends will come and go, interest rates will come and go. And I think what makes great founders is the ability to lead through crisis and changing markets, right? And great products.
Yeah, and if I can just add, I think if you see, Aussie founders are much more used to the whole focus on business model fundamentals, focus on revenue and ensuring that, whereas US founders, they're not used to that, right? They have to now learn that behavior. So it's going to take them a bit longer to get there. And that's the real competitive advantage that Aussie founders have. But you do, Peter and I both raised the point, you have to get over there. You have to understand the market that you're playing in and keep that sort of more, Aussie conservative mindset, because that is going to set you up well in this current economic situation.
So if I was to ask you a question, say if you were to go to the US and the minute you land, right, like what would your first point of call be? You're a PropTech that's looking at scaling into the US. What would you set your intention as when you land there? What are the sort of steps that you would follow, say for the first couple of days at least?
I can fill this if you want.
Yeah.
I would have a plan before you get on the plane to start off with, AJ. That's number one. But there'd be 4 channels that I look at. Well, one would be major conferences and events to go to. I would be looking at winning the hearts and mind of influencers. Influencers in the American property industry are really big, and they grow your company free if you service their needs. And there's nothing weird about that. That's just, they want to be on the cutting edge of PropTech. And if you've got something that is cutting edge, they love sharing it, and you want to get it out there to influencers and coaches. They're big in that space. The third thing is I'd be trying to figure out how to get a content marketing strategy for your PropTech up that involves media picking you up free of charge. This is going on a budget. And the fourth thing would be boots on the ground. You need to plan which conferences and events you're going to be at. And Marisa spoke to this before as well. Obviously, Box Brownie was huge at this, but we would go to as many conferences as it took to get the messaging out there. But all of those sort of shelved under what's your target audience, who are these people, and where are they at? But that'd be the 4 strategies for American companies. Another really cool way in is through Canada. Don't land in America, land in Canada. Figure out how the market works in controlled circumstances, and then embark on a launch. And we've seen Open and Rate My Agent both did that.
Excellent, thank you, Peter. Ari, any closing comments?
No, I tend to agree with Peter's strategy just now. I actually think another thing that you may want to do beforehand is find out who your competitors are. Have a conversation with them. See if they'll be willing to talk. Sometimes people are just willing to talk, and you can sort of strategize that way. I also think that Marisa had a really good point earlier when she talked about there's so many differences in the markets, in the MSAs within the United States, that it's difficult to just say, I'm going to go to Laguna or I'm going to go to Tallahassee, because there are just a ton of markets in between. I think you need to understand your market and what your plan is. You need to have a good plan before you head over.
Excellent, thank you. That's all we had time for today, guys. It's been eye-opening. Actually, it's been really good. It's been really refreshing, and I appreciate your time, and our community appreciates your time. And this video will be recorded and put onto our channels as well. Feel free to connect with anyone on LinkedIn that's on this panel. I do appreciate your time. Thank you very much. And to the PropTech Association, thank you to all board members within the PropTech Association. I appreciate you putting it through the event, and also to Stone & Shaw. I appreciate your time. Thank you, everyone.